I kept the receipts. This is the time of year on the podcast that I like to look back at a few forecasts that were made at the end of last year, the end of 2024, and see how they turned out so far this year. We'll also look at our own views that we shared in our 2025 Outlook piece at the end of last year. And the point of this exercise is not to poke fun at all the various Wall Street shops or to puff up or degrade our own projections. It's the point of this exercise is to demonstrate how difficult it is to project, especially over the short term, where investment markets are going to go. Understanding how difficult it is to predict exactly whether the market's going to go up or go down in the short term, and perhaps a little bit of humility, has significant implications for how we as investors should start to build portfolios. And so we'll talk about at the end of the podcast how to invest, considering how challenging it is to be right about the future and to have that crystal ball all the time. So let's dive in. Let's start with the economy. Overall, I think economic forecasting is perhaps better than stock market or asset market forecasting. The U.S. economy, I liken it to an oil tanker. It's really hard to turn it one way or the other. Usually you see change in the data happening before it starts to move significantly in a new direction. And when we think about the performance of the economy in 2025, your perspective on the performance of the economy depends on where you sit. Real GDP, or sort of the broadest measure that we have for economic growth, was 2.1% in the third quarter for the year-over-year growth. So we're still growing, which right around trend growth, which is 2%, probably going to end the year right at or maybe slightly below 2%. Certainly not recession territory. In fact, that's, like I said, that's pretty close to trend growth in aggregate. However, almost all of the positive contribution to gross domestic product or GDP has come from the CapEx cycle that's related to the AI build-out, and to some extent from consumer spending that's propped up by those soaring equity valuations of the AI stocks. So without that AI related spend in the third quarter, we would have been in a recession. In fact, most of the economy was in a recession. So your perspective on the performance of the economy this year depends on how close you sit to that AI cycle and whether you're invested in it or not. Foreign economies also grew a lot faster than expected this year as foreign countries increased their spending on the back of U.S. foreign policy changes from the Trump administration in January. And then from an inflation perspective, inflation is pretty flat compared to January of this year. It's running about 3%. It fell over the earlier part of the year, and then it's accelerated recently as tariffs began to have an impact on prices over the summer. So what were expectations coming into the year for the economy? What did some of the folks say in their outlook pieces for 2025? Well, Goldman Sachs expected the GDP to be 2.5% and for inflation to be 2.4%. So fairly close, maybe a little bit light on the inflation side, but pretty close. JP Morgan expected 2% GDP growth and cooling inflation in the first half, followed by higher inflation in the second half as tariffs were implemented. So that's pretty spot on. Wells Fargo and UBS were more sanguine about U.S. growth being subpar and soggy, were the words that they used. They expected GDP to be in the 1% range. So they were low on the total number, but not so wrong on the rationale for how they got there. They foresaw the strain high rates and inflation were putting on real Main Street businesses and consumers, and correctly expected them to struggle this year. They just underestimated, as did most people, the sheer scale of the impact of AI on the economy. So overall, economic forecasts were mostly close to target. None of the major investment shops expected a recession this year. That's different from maybe some of the prior years. And we didn't have a recession in aggregate. But I don't think anyone fully appreciated the divergence in the economy that you hear about, the K-shaped economy. I don't think anyone expected the CapEx build out for AI to be this substantial. And I don't think folks expected the low-end consumer and the real business economy to struggle quite as much as it did in the second half of this year. If they did, they would have forecasted a recession, right? So the bears were not wrong about the real economy, and the economic bulls were not fully right about the extent of the AI build out. My own thesis on the economy was that we would have weaker growth in 2020 than we saw in 2024, but that we wouldn't have a recession. I focused a lot on the Fed potentially making a policy error and leaving interest rates too high, which could potentially choke the economy off and cause growth to slow and unemployment to rise. I also spent a lot of time in the outlook for this year talking about the quandary the Fed might have on its hands as the real economy slowed, unemployment, the jobs market got weaker, and inflation remained stubbornly high. And we've largely seen that come true. Unemployment has risen slightly. The real economy, like I said, most consumers could benefit from lower rates yesterday, not in the future, not when we get a new Fed chair, but earlier this year, it would have probably been better for rates to be lower. But overall growth has remained strong. Like many others, our outlook for this year hit the nail on the head for what's happening for 95% of the economy, but we also underappreciated the scale of the AI build-out. I also expected inflation to move lower than what we've seen occur. Inflation should be just above 2%. I thought tariffs wouldn't happen, or if they were implemented, they would be implemented in a less significant way. And that may still be true. We could see the Supreme Court come in and refund all of that tariff money here over the next couple of weeks. But the tariffs really have kept inflation that should be rounding down to 2%, closer to that 3% number. So economic forecasting seems fairly straightforward. You might say, okay, the firms mostly were close to right about the strengths and weaknesses of the economy this year. But what about the stock market performance and expectations? And that's where this exercise always gets a little bit more fun. So let's talk about the stock market. The S&P 500 is currently trading at about 6,820, 6,820, up about 16% year to date. We don't make S&P 500 level calls each year precisely because it's hard to do, and it's not super useful from an investment perspective, and we'll talk more about why that is in a few minutes. But for those that do dare to play this game, let's look at some of their calls. Both Goldman Sachs and JP Morgan Asset Management expected the S&P 500 to end this year at 6,500. That's about 5% below today's levels, so pretty close. Both were also expecting a broadening rally, which meant the non-AI stocks were going to outperform the AI stocks and catch up. And that has not come to fruition so far this year. The AI growth cohort, those tech stocks, hyperscalers continue to dominate the market. And that's led to all the bubble discussion that we've heard over the last couple of months. Bank of America Merrill Lynch was probably the closest on their S&P 500 call. They expected the S&P 500 to grow to 6,666 in 2025, a really specific number. And they expected for stocks that supported the AI build out, like utilities and some forms of construction, to outperform. And that turned out to be pretty prescient. What about some misses? So UBS's investment bank expected soggy growth, like I talked about a minute ago, and they expected the S&P 500 to finish the year at 5,800. That's a 17% miss. Oops. BCA Research, which is an institutional research shop widely used by large investors in the US, Canada, and around the world, they expected the US recession, and they also had an S&P 500 target of 4,452. That's off by almost half. Their concerns about the economy were not misplaced. We certainly have had real issues in the real economy, but not understanding how AI growth could continue to drive markets higher caused those firms to miss pretty significantly. The stock market and the economy are not the same thing, and they often, certainly the economy influences the stock market, but they don't always move exactly in the same direction at the same time. If we look at some sort of calls within specific sectors, Neuberger Berman, a storied asset manager, and Stifel, which is a Midwestern investment bank, they were really bearish or underweight those AI tech stocks that led the market all year. So adhering to that strategy would have been problematic. The other major theme in the stock market this year has been the outperformance of international stocks compared to U.S. stocks. International developed markets have bested the S&P 500 by more than 10% so far this year, and emerging markets have done even better. They're up 30% so far this year compared to 17% for the S&P 500. Cambridge Associates is a pension fund advisor, and Vanguard, they were among a very small handful of firms that expected this outperformance from international markets. Not Morgan Stanley, not JP Morgan, not Edward Jones or Merrill Lynch. Nobody expected international developed markets really to best the S&P 500 by more than 10% this year. My views in our 2025 outlook for the stock market were that the stock market would have a solid year, but it would be closer to average returns in the 7 to 8% range. I dismissed the bubble talk. If you go back and listen to that episode, I was skeptical that the stock market could repeat with yet another year of double-digit gains. Turns out I was wrong. The market had plenty of legs, and the returns outpaced even my expectations, which were positive for the year. So it turns out that even with lots of economists and PhDs and quant jockeys, it's very difficult to forecast what the stock market will do, especially over a short period of time. Okay, stocks aren't the only asset that's out there. What about bonds? Is it easier to forecast the rates market or what's happening in other asset classes? PIMCO is the world's largest bond manager. They expected strong returns from bonds in 2025 as the Fed cut interest rates this year. PIMCO suggested that investing in longer-term bonds over shorter-term bonds, and their forecast was pretty correct. Bond markets have had a good year so far. The U.S. Aggregate Bond Index, those boring, stodgy old bonds in your portfolio, the Aggregate Bond Index is up 7% so far this year. Pretty good returns. The problem is they also suggested that bonds were more attractive than stocks. Perhaps some of that was talking their own book, convincing investors to invest in PIMCO funds, of course. But if you only invested in bonds, you missed out, of course, on significant stock market returns this year. PIMCO also suggested sticking with quality corporate bonds and lower risk treasuries. However, the high yield sort of junk bond market has again outperformed this year. So they were partially right in their forecast to be bullish on bonds, a C plus maybe, but they were wrong in some of the ways that you should do that, and certainly wrong to prefer to imply that bonds would outperform stocks. BlackRock, the firm that puts most of the iShares products out there, there's ETFs. BlackRock wrote that the era of easy capital gains in bonds from falling rates was over. It might be over now. That era might be over now, but only after rates fell in 2025. So that was a miss. PGIM, another big bond manager, they actually did slightly better. They were bullish on bonds to start the year, but they were rightly more focused on those higher yielding securities, suggesting that investors should focus on what we call carry, which is just investment speak for generating your portfolio returns by just receiving those interest rate payments every quarter or every month and not focusing so much on the direction of interest rates. Cambridge Associates, again, actually got both the stock and bond market calls right for 2025. So kudos to them. I think that puts them in a group of one, as far as I can tell. They expected international stocks to do well, and on the bond side, they expected higher yield securities and longer term bonds to outperform. So A plus for them. So like the stock market, the bond market is also not impervious to bad forecasting, despite the best efforts of some really smart investors. The pros got some things right and some other things wrong. My own views were actually pretty close to those of Cambridge Associates in the bond market. I expected rates to end the year close to 4%. That's very close to where we are right now. That meant focusing on longer term bonds. I also didn't expect a recession. And so despite narrow credit spreads, I suggested sticking with the higher yielding bonds. So both of those calls in our outlook turned out to be right. What about gold? Gold is by far the top performing asset class this year. Most major firms, JP Morgan, Goldman Sachs, a bunch of others, expected gold to have a strong year, up perhaps 15%. Gold's now up more than 50% for the year. We'll see where it ends as we close in on the end of the year. Fitch Ratings and HSBC expected gold to drop in value or go down. Whoops, that was a problem. So it was right to go for gold, which were the words that Goldman Sachs used in their outlook. But even the folks that were bullish didn't expect the significant run-up that we've seen this year. So when you take our own outlook, if you take the Capital Stewards outlook in full, we were close to right about the fixed income environment, but we were not bullish enough on the stock market. We were right about international markets, wrong about the US being able to produce another year of double-digit gains. So like most firms, we were right about some things and some asset classes and wrong about others. And so when you look at these outlooks that are published by most investment firms, that's what you're going to get. They're going to be right about some things and wrong about others. So should we just ignore all these outlook pieces as investors? After all, why do investment researchers spend so much time trying to understand the market? And the answer is really two-part. First, forming a point of view and trying to predict the future for any market or asset classes and investing based on your perspective is a challenging way to generate long-term returns. Occasionally, your point of view will be right and your predictions will be right, but often you're going to be wrong. And as you can see, all the king's horses and all the king's men and all the quants and all the PhDs and all the people on Wall Street struggle to accurately forecast all of the investment opportunities and all of the asset classes correctly every single year. My view is that a better approach is to build a portfolio that you can stick with over time, and that should have a mix of asset classes that do well in different markets. Trying to pick which assets are going to outperform every single year and by how much is a very difficult, if not impossible task. In most years, your stock portfolio is going to drive returns as the economy grows and companies do well. But in some years, you're going to need bonds, precious metals, gold, commodities, and other assets to provide returns and stability in the portfolio when stocks go through a downturn. As you can see from the predictions from the last couple of years, it's hard to know in advance when that's going to happen. So how do you know if your portfolio is constructed? First, I think you should be achieving your desired returns in most years, and you should be on track to accomplish your goals. That means you should be looking at your retirement plan, your financial plan, and saying, hey, am I achieving the returns that I need to be achieving to hit my plan goals, right? And you should be working through that with your advisor on a regular basis, saying, hey, are we on track and is it clear? Am I getting regular performance reporting and can I see what my portfolio growth rates are and how do those stack up to what we expected them to be, right? So that's the first way to know if your portfolio is well constructed. The second is that you should have assets in your portfolio that move in opposite directions. If everything is going up, that's a problem because when the downturn comes, everything will likely go down. So you need to have some balance, even when markets are really strong, which is what we've seen over the last couple of years. So what about those outlook? What's out all these outlooks? What's the second part here? I do think the outlooks have value. And that value is not to predict exactly what's going to happen in every single asset class over the next year, but they do have value in helping you better understand the risk and return trade-offs that you're making as an investor. What might happen if someone's perceived vision of the future unfolds? What might happen if they're wrong? Can you live with those different outcomes? What are the risks? What are the opportunities? And that's where good portfolio construction, the right mix of assets, is so important. You can be confident, or you should be confident, that your portfolio will stand the test of time and you can stick with it in both good and bad years. And that's where having the right mix of assets that are moving in different directions is so important, because it will help you stick with it over time. If you don't stick with it over time, that's where you make the worst investing mistake of all. And that's to buy high, chase returns, and then ultimately sell after the crash. You sell low, and that destroys capital along the way. So that's what we want to avoid. And that's why portfolio construction and having the right mix of assets is so important. So I think understanding different perspectives on where the economy and markets may be headed is important. But if you're going all in on one view or another, you should be wary that you, like most of the experts on Wall Street, you might not be right. And you need to be comfortable with the risk of being wrong a whole lot. So with that, we've had this kind of look back at 2025 and what some of the forecasts were, and evaluated some of our own forecasting. So hopefully this gives you some perspective on how to listen to these forecasting episodes and how to listen to firms when they talk about their outlooks for next year. In the next episode of the podcast, we, of course, will have our own outlook for 2026. So look for that to drop into your feed sometime soon. And we'll see you on the next episode of the Capital Stewards Podcast.